The office sector of commercial real estate has come under scrutiny due to the recent banking turmoil and concurrent interest rate hikes. So Moody's analysts find that nearly a third of office buildings in its top 80 metros could be, quote, obsolete. So how vulnerable is the commercial real estate market? Morgan Stanley thinks prices could fall as much as 40%, but is commercial real estate's relationship with banks necessarily a doom scenario? Here to weigh in is Moody's Analytics Head of Commercial Real Estate Economic Analysis, joined by Commercial Observer's Finance and Co-Deputy Editor, Cathy Cunningham. Welcome to you both. So first, I want to start with you, Kevin, because a lot of people, we first heard some of these warning signs from the Fed about the impact on commercial real estate when rates were being risen, but then also add to that the banking fallout from SVB. Give us the real context here as to comparisons that are now being made between that and the global financial crisis.
Sure. Thanks a lot, Rochelle, and thanks for having me on. So, yeah, I think we're in a very interesting time right now in the sense that there's a lot of hand-wringing going on, and there's a lot of legitimate expectations of a down cycle to come for commercial real estate, including from us. Where we might differ is on the magnitude, and there's a lot of reasons for that. If you go right to the banking sector question that you brought up, a lot of statistics have been flying around out there about somewhere between 65 to 80% of all CRE lending coming from regional banks. So if there's problems with regional banks, that's a major source of lending for the CRE industry. While it is a major source of lending, it's actually only about 13% of lending for CRE. There's a misreporting of that stat that's been kind of going around the echo chamber right now. And so that's one of the big differences, actually, if you step back for a second and look at GFC compared to now, the global financial crisis compared to now. The diversity of debt sources in the CRE market is much greater. There's a lot of non-bank lenders. CMBS continues to take up a big portion. Life insurance companies, Freddie now exists for the multifamily market. So that really helps bolster on the debt side. And there's a lot of fundamentals about the real estate sector that are very different now than they were 15 years ago.
And Cathy, you would think, based on some of the headlines that we're seeing, that this was a sudden issue that suddenly came up. But as you mentioned, this is something that was really happening years and months in the making.
Yes, for sure. I mean, I think our industry has really been in a prolonged period of market volatility as a result of the rising rate environment. We've really seen volatility, I think, in CRE lending for roughly 9 or 10 months now. Really, the rate environment was such a shock to the system because it happened so quickly. And I think the collapse of SVB, what it really did was shine a light on some of the vulnerabilities within commercial real estate. And as Kevin said, yes, this seems like the end of the world. You see a lot of the headlines today, especially the comparisons to GFC, which I think is really the worst crisis that a lot of us can remember. But there are so many other different lender types that are still out there lending. The non-banks are playing a big role just now as the banks retrench and kind of sit on the sidelines. And I think, it's not all doom and gloom for sure. We're definitely going through what I think will be a very, very rough year for commercial real estate. But I think, not all is lost. And I think we definitely will recover from this, obviously. And it's a temporary time period of volatility.
So then, Kevin, as we look within the CRE borrowing space, then what are some of the trends that we should be aware of as you look out for the rest of the year?
Yeah, well, I think there's two sides of this coin. One is the CRE's exposure to banking as a lender, and then banking exposure to CRE as a potentially volatile asset class. And one of the stats that you just had up on there was the share of holdings of banks that are attributable to CRE. It takes some nuance actually to understand that statistic. And you really what accounts for CRE, like income producing properties, is actually a much smaller share of regional bank holdings. It's actually on average about 16.5% of their total assets. When you break it out, there are some that have actually some big concentrations. So they're definitely, if you feel like there's some problems in CRE, there are some banks to watch because of their exposures. But on average, it's only 16.5%. But as we go forward, you asked about things to watch. I think what we're really watching is the refinancing that are coming up right now. So, CRE loans are generally 5 to 10 year loans. So you're looking from the period of origination of 2013 to 2018. The good news is those were priced pretty conservatively relative to just before the GFC. So your spread, your cap rate spread, which indicates your enthusiasm about the future growth prospects for that property, and among other things, If that spread is really tight, that means you're being very aggressive in your pricing. But this last 10 years, we have not seen that. So there was not a pretty conservative pricing in that 2013 to 2018 era. And also LTVs on loans were 5 to 8% less. That's a really structurally fundamental difference between now and the GFC. You can take a lot more value decline before you experience a loss as a lender. So as these maturities come through, we're definitely going to see some pain. We can see default rates come up in the 5% range. Nothing like that. It was double that in the GFC. For sure, we're going to see some weaker assets that have issues in this next couple of years in that refi wave. But this idea of comparing it to what happened in the GFC, which was incredibly painful for CRE for some really fundamental reasons, is just not really a fair comparison.
And Cathy, to that point, you also note that, and you say it's actually a bigger comparison would be to the savings and loan crisis. Break that down for us.
So I really think, the SNL also had the same context in terms of the rising rates. The GFC, I think, is so different on so many different levels because of the amount of financial engineering that happened during the GFC. Thank goodness today we don't see the same level of, CDS, credit default swaps, collateralized debt obligations. All the things are very, very troubling for RMBS, CMBS, the residential commercial industries during the GFC. I do think that, post-GFC, lenders have been far more disciplined, far more conservative in terms of the loans that they're making and their underwriting of those loans. And I also think borrowers have also been far more conservative or easy about the loans that they're taking and what they actually need and the amount of equity or skin in the game that goes into these deals. So I think the whole playing field when it comes to commercial lending is so different than 15 years ago, 16 years ago. And so we're in a better place starting off in this crisis than we were pre-GFC.
And Kevin, as we look within the specific types of commercial real estate, are there some that are perhaps holding up better than others?
Yeah, absolutely. It's a very diverse asset class. Before I go on to that, though, I would like to echo something that Cathy said there about the banks. There are some fundamental things in place now, some liquidity backstops, including one that was just started by the Fed called the BTFP, where banks can borrow for up to a year on the book value of their assets, which kind of separates them a little bit from the risk of value volatility. So it's a very important thing to note about what's happening in the banking sector. But to your point about heterogeneity in the commercial real estate asset class, that's one thing that people always have to remember. It is a very heterogeneous asset class, and even among the more troubled sectors like office, there are properties that are doing quite well. They have long leases, or they have, the kind of draw amenities. A lot of leases are still being signed. You don't see headlines for when big leases are signed, but you see big headlines for when they're not, or when tenants decide to move out. But when you get into the data, you see there's plenty of leases still being signed. Office is still a needed thing. Most serious people in the CRE market don't think that this is a functional obsolescence issue for the entire sector. They think it's a much more nuanced thing, and there's a repricing between 20 to 30% that needs to happen before lenders start feeling comfortable lending on office again. Multifamily has a little bit of issues. Affordability is becoming more and more of a problem across the United States, really. And the pricing on those assets actually has been very, very tight. So that spread I mentioned over the Treasury on your cap rate has been extremely tight for multifamily. So when these rates start to go back up like they have been, there's less breathing room. So you can see some real unexpected price corrections in the multifamily sector for such a strong asset class. The pricing has just been too tight for many of them. Industrial has been very strong. Retail has actually been quite strong, surprisingly. It's malls that really have experienced the most pain. They're going through a whole reinvention, akin to what some offices are going to have to go through. But the kind of normal neighborhood community shopping centers have been sleepily doing well. And hotels, they kind of bounce all around all over the place. Surprisingly, hotels are one of the only positive stories right now. Coming out of COVID, they got hit worse probably than any business sector at all, the hospitality. But they've made a big comeback. They've really ridden the wave of revenge travel that's still going on. The TSA numbers are still 110% over what they were in 2019. So that sector is actually doing well right now, but it's extremely pro-cyclical. So if the economy turns down, don't be surprised if hotel does as well.
It's certainly important to note all those nuances when people see some of these big headlines, to dig a little bit deeper there. A big thank you there to our panel, Moody's Analytics Head of Commercial Real Estate Economic Analysis, Kevin Fagan, and Commercial Observer Finance and Co-Deputy Editor, Cathy Cunningham. A big thank you to you both. All right, coming up, to the moon, or maybe not.